This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, back in Chapter 2, it seems a long time ago now, no doubt, we were introduced to the income tax computation. And since then, we have seen that there are two main sources of income that UK taxpayers are likely to have. Those are their forms of earned income, be they, as we saw in Chapter 9, employment income, and of course for the self-employed, as we saw between Chapters 4 and Chapter 8 there. We have got trading profits that would arise in relation to those self-employed individuals. Now, those profits of the unincorporated trader, the salaries and wages and assessable benefits of the employees are all chargeable to income tax. Well, there's another tax that will be imposed directly in relation to either the salary or wages of the employee or the trading profits of the individual. What we have here is something called national insurance contributions. Now, you don't need to know about the history of this. It was originally founded to help fund the welfare system for employees, for workers within the UK, in terms of health benefits, in terms of unemployment benefits there. But nowadays it's just another tax charge that goes into the central coffers, and along with the income tax is used to pay out, of course, for things like NHS, for things like social welfare, unemployment benefits, etc. History of it doesn't matter to us, but what we are interested in is how to calculate it. And what we're going to see is that there are various classes of national insurance contributions that we'll become familiar with and will need to be able to compute. Always likely that if you don't see it in the Section C question, you're going to have a Section A question, at least one 2-mark question, that is going to identify the need for you to compute the national insurance contributions for a particular individual or individuals. We start, therefore, with, here in Chapter 11, employed earners, dealing with employees. Now, in relation to employment income, what we're going to discover is that there are two amounts of national insurance contributions that are payable. One, as you may have guessed from what I've said already, payable by the employee. Class 1, as it's known, employee NICs, national insurance contributions, NICs as we'll refer to them from now on there. So employee Class 1 NICs. But if you are in employment, it's not just you, the employee, that has to make those NICs. What the employer must also do is to pay over their secondary or employers' NICs. Class 1 contributions, therefore, looking now at your notes here in Chapter 11, the Class 1 NIC, as we have just referenced, is paid by both employees and employers. The question, therefore, is what is paid by the employee and what is it based upon, and what is paid by the employer. Now, there are a number of different rates and limits here in terms of how the NIC system is applied for any individual employee or any individual unincorporated trader. So what will be useful as ever is that you go back to your rates and allowances page at the beginning of the study notes, and you'll see this particular page that you can now see in front of you on the screen, where we've got both Class 1 employee, Class 1 employer contributions. And what you can see there is that there are limits. There is a lower limit of £8,632, below which you do not pay. It is a rate of 0%. Then between that lower limit and up to an upper limit of £50,000, the main rate of Class 1 employee NIC is chargeable, 12%. Now, what this is chargeable on, we'll see the precise definition in a few minutes' time, but it's basically, of course, on your salaries and wages there, your cash earnings. So that's the main rate, 12% between the lower limit and the upper limit. The lower limit, 8632, up to which you do not pay, and then above 8632 and up to £50,000 of employment income, 12%. Now that will be dealing with your cash earnings, i.e. it'll be your salary, your wages, any bonuses, any commissions there, cash earnings. What it does not pick up on are any taxable benefits, non-cash benefits. What they are charged to, as we'll see a little bit later, is Class 1A contributions. So that is paid by the employer. Class 1A, that's on benefits. But in relation to your cash earnings, your salary, wages, bonuses, commissions there, your cash earnings, we have both employee contributions where there is the lower limit of 8632, upper limit of 50,000. Between those limits, you pay at 12%. Above the upper limit of 50,000, it drops to 2%. We'll explain the reasoning behind that in a moment's time, but those are the numbers, these are the rates to apply. You don't have to remember them, you simply have to look at this table. Employer contributions. We said that for the privilege indeed of employing you as an employee, not only does the employee have to pay over the national insurance contributions, but the employer must also make national insurance contributions. We have the same lower limit of 8632, below which there is nothing to pay. But above that lower limit, there is then a standard 13.8% rate. There is no upper limit. There is no point at which that rate becomes smaller. For employers there, as soon as these cash earnings for each employee goes above £8,632, we're talking in terms of 13.8%. Though for the employees in total, any total amount of Class 1 employer NICs may then be reduced by a so-called employment allowance. Now, this is not a specific deduction against any individual employee's Class 1 employer NIC. This is a total deduction. So if in a question you are asked to compute the Class 1 employer's NICs in relation to a particular employee, the Class 1 employer's NIC for that employee, you are not then going to deduct the employment allowance. It is a deduction that is made from the total of all of the employer's Class 1 NICs. But that employment allowance is a £3,000 deduction. Again, we'll see reference to that in the detailed notes in a moment. As we said, over and above your cash earnings, which depending on the level of those earnings for any given tax year, we have employee and employers NICs to compute. The Class 1A, these are your taxable, your assessable benefits in other than in cash form, and that has the same rate as the employer's Class 1 NIC's 13.8%. Although it doesn't say it here, as it will see in the notes, this 1A contribution, these are paid by the employer, only by the employer, not by the employee. Okay, Class 2 and Class 4 deal with the self-employed, but let's go back and look at employment income to begin with. So going back to our notes, Class 1 NICs paid by both employees and employers, depending on their level of cash earnings. Employees. The contributions begin when the employee is age 16 or over. So up to age 16, doesn't matter if you are earning, not that many probably will be, but there'd be no NICs. From 16 and above, then national insurance contributions become payable by employees. And those contributions will then cease when the employee reaches pensionable age. Now, you don't need to know what that pensionable age is. At this point in time in the UK, we're going through a period of transition where we're going, for men at least, from the point of 65 as the state pensionable age through to eventually 67 over these next few years. Again, rather more unfortunately for women, moving from 60 as it used to be in years gone by through again to the same 67 years of age. But again, you don't need to know that. What we do need to know is that for 1920, as we've seen, the rate of employee Class 1 NIC is at 12%. Now that's the main rate. that runs on those cash earnings that exist between the lower and the upper limit. Again, cash earnings there, where they exceed that threshold of £8,632 per annum, but only up to the upper limit of £50,000 per annum. We go above £50,000, and then there is a rate of 2%, with no upper limit thereon. Anything and everything above 50,000 for the employee is 2%. Now again, why do we pick on that upper limit of £50,000? You think about it on your income tax computation. We know that we have a personal allowance of £12,500, a level of tax-free income. We know that the basic rate band limit, which on earned income, non-savings income there, we have a basic rate of 20%. The basic rate band limit on such taxable income is £37,500. So if you had employment income of exactly 50,000 minus the personal allowance of 12.5, you would have exactly taxable income of 37,500. You would be on the basic rate band limit. But if your income, your employment income went above 50,000, ignoring any other sources of income for purposes of this illustration, if you go above £50,000, then you would become a higher rate taxpayer. If we go above 50,000, take off your personal allowance of 12,500, assuming it's all available, you're going to be left with a taxable income figure in excess of 37,500. So your basic rate band of 20% is replaced by a higher rate of 40% there. So we're doubling the income tax charge. So what happens with the national insurance contributions up to £50,000, effectively the basic rate band limit for a taxpayer, up to that £50,000 from your opening figure of 8632, we have a 12% employee class 1 NIC. But then as your employment income goes above 50,000, you move up into higher rate tax. So your income tax charge goes from 20% to 40%. Therefore, they don't want to be charging both 40% and still 12% NI. That would be 52% of your income there, employment income, that you'd be losing in tax charges. And that's a very formidable number. They'll be taking more than half. So what happens at that upper limit, we reduce the employee class 1 NIC rate from 12% down to 2% there. So effectively on employment income, within the basic rate band, once you've gone above 8632, that is, you're suffering your income tax at 20%, your employee NIC at 12%. 20 plus 12, so that's 32% tax charge effectively in total on employment income within your basic rate band. You go up into higher rate, employment income here above 50,000. Higher rate, your income tax rate goes to 40%, but your NI, your class 1 employee NIC drops from 12 down to 2. So in total, 42% is effectively what you would be charged. Now again, these calculations are kept separate. I'm just trying to inform you here about the logic behind how the system works. What you're going to have in the exam is a doing exercise, whereby you've got to calculate what these class 1 employee national insurance contributions will be. So we don't have to remember the lower upper limit. It's on your rates and allowances page, as we have just seen it there. That is available to you in the examination room. All we've then got to do is to apply that. Now, be careful in terms of any objective testing questions, as we have said so many times before and will continue to say in future chapters. Indeed, chapter 12 coming up after this on capital gains tax is another classic area where we've got to be so careful in reading exactly what is the requirement of any such objective testing question, so we don't make a wrong assumption there and go and calculate something that could have been asked for, but hasn't been. We must make sure we are answering the precise examination question. So when we see employment income, what's the question asking us to do? Is it asking us just to look at employee NICs? Is it asking to look just at employer NICs? If it is employer, is it just Class 1 employer NICs, or is it both Class 1 employer and Class 1A employer national insurance contributions as well? Or are we asked to compute the total of all national insurance contributions in relation to an employee's given figure of annual salary? So again, we've got to interpret that question very, very carefully. Employers, as we have seen on the table, the rate is 13.8%, again on cash earnings, and only those that exceed that threshold of £8,632 per annum. Again, are payable from the employee's 16th birthday, but this time there's no upper age limit. For employers, there's no upper limit at which the 13.8% reduces. It stays at 13.8% up to whatever level that employment income may be. There is no upper limit, and equally there's no upper age limit either there. Again, whatever age of the taxpayer, though the employee NICs will cease when you reach pensionable age, it doesn't happen in relation to the employer. And as we said, we've got Class 1A contributions. These are those payable only by employers, and they are on the taxable benefits provided to an employee. It's exactly the same rate as for the main Class 1 employers NIC, 13.8%, applied on the assessable value of those benefits. So Class 1A, only the employer, picks up the non-cash but taxable benefits. Cash earnings, your salary, your wage, your bonuses, your commissions for the year, those are subject to Class 1, both primary employee contributions and what may be referred to as secondary employer contributions there. So again, be careful to interpret the question correctly as to what it is that you need to compute. Just one thing there in relation to cash earnings. The usual ones that we're talking about is the ones I keep referencing. Wages and salaries, obviously, bonuses paid, commissions paid, all of those are cash earnings. What you may see in the odd objective testing question within either any of the ACCA providers' exam kits is another cash amount that you might get from an employer is where you use your own car for business employment purposes there. And as we saw early on in Chapter 9, what we had was the potential for an assessment to arise if the employer reimbursed the employee at rates above the approved mileage rates. Now again, you may recall that those approved mileage rates, I wonder if we can find them back here, were 45 pence per mile. Here we go, the authorised mileage allowance rates. 45 pence per mile up to 10,000, over 10,000 miles, 25p. Now, as regards employment income, if the employer reimbursed at above those rates, there was an assessment. If it was below those rates, there'd be an allowable deduction to take away in deriving the employment income assessment of the individual. What now happens for national insurance contributions is if we are paid this mileage allowance by the employer, if that goes above just the one figure, 45 pence per mile, no reference to the 10,000 miles there, this is all miles. Anything above 45 pence per mile paid by the employer to the employee, that would be classed as cash earnings. That excess above 45 pence. Again, not stopping at 10,000 miles, whatever it is, at 45p. If the employer reimburses at above 45 pence per mile, then on that total reimbursement, the excess above 45p, that is classed as cash earnings and would be chargeable to Class 1 NIC contributions, Class 1 employee NIC contributions, as well as Class 1 employer contributions. That would be classified as cash earnings rather than just a taxable benefit that would have only suffered employers' Class 1 NI at 13.8%. Again, it's a rare one, but you might see that in the odd objective testing question. Going back to our main notes here, as we have seen on the fact sheet provided, there is an employment allowance of £3,000. Now that is per employer, not per employee, and it reduces the employer's Class 1 NIC payable. And that's a reduction from the total of all of the Class 1 employers' NIC. Again, only employers' Class 1 NIC is this employment allowance deductible from. So if that figure was £5,000, the amount payable will be reduced by £3,000, and obviously that would reduce it down to £2,000. If the total for all employees had come to only £2,500 or anything less than £3,000, then obviously the figure would be reduced to nil. That employment allowance is only available where you're talking about companies, businesses that employ other people. It's not for sole businesses, employees, where you set a company up and you are the only employee. So the employment allowance is not available to companies where a director is the sole employee. Now, that restriction was introduced because, as we said, the employment allowance is targeting at businesses which support employment. It's an encouragement for employees to employ more employees. That's the idea. It's not designed that a one-person company, one-man, one-woman company, a one-person company, that individual can get a £3,000 reduction in the employer Class 1 NIC, which is entirely to do with their earnings. So not available in that circumstance. That issue there is something that could be tested in terms of, in Section C, we know there's going to be two 15-mark questions, one based on income tax, one based on corporate tax, and then a 10-mark exercise. And frequently in current years, we've seen that that 10-mark exercise takes on a more planning style. And what you have at the end of these notes is Chapter 6, which deals with tax planning situations, one of which is looking at an individual setting up his or her own business where they have a choice. When you set up a business, you could go unincorporated or you could go incorporated. And one of the things that we're going to have to do in relation to the business and the profits made by that business is to work out in relation to our income tax and national insurance contribution system what total liabilities would arise in relation to income, whether it's income tax charged on the income or whether it's now NICs charged on that income. So the non-availability of the employment allowance will be particularly relevant in certain tax planning scenarios. For example, as we've just said, when deciding whether a sole trader with no employees should incorporate their business. Should I continue to operate or should I set the business up originally as an unincorporated trade, a sole trader, or should I incorporate either at the very beginning when you start to trade or at a later point in time? Should I incorporate? And the then associated decision as to whether to extract the company profits, where the director is the sole employee, as either director's remuneration, upon which of course NIC would be payable, or as dividends, upon which no NIC is payable. And again, the detail of this is in Chapter 26 that you'll see at the end of your studies once you've got a good overall knowledge of all of the different taxes and tax systems that apply there. If you are the owner of an owner-managed company, look at the two words there, owner-managed. In your capacity as owner of a company, what do you own? You own the shares in the company. And in relation to those shares, what income could you derive? Dividend income. So an owner-manager of a company could take the profits of the company out of the company and put them into his or her personal pocket in the form of a dividend payment. In your capacity as manager, probably the managing director of your company, you could pay yourself a salary there. Now that salary would be employment income. And on employment income, we've got both income tax at the relevant non-savings rates, and depending on how much employment income we take from the company in any one tax year, there may be national insurance contributions as well, payable both by the employee and by the company, the employer. In relation to dividend income, that's not employment income, that's not, again, trading profit. That dividend there is being paid by the company out of its already taxed profits. The company will have its profits, they will be subject to corporate tax. Out of those taxed profits, out of the distributable profits, a dividend will then be paid. And you know already that in terms of the individual receiving that dividend, we've got very different tax rates to deal with. We've got our dividend income nil rate band. We've got 7.5%, 32.5%, 38.1%. A very different set of tax rates. Now, all of that is for discussion and reading later on, once we've got a basic command of each of the taxes within our syllabus. Again, at this point in time, all we need to know in terms of computing our employer national insurance contributions is if you were computing the total NICs for the employer, you'd have available an employment allowance of £3,000. If you are asked to deal with an employee and compute the employer's Class 1 NICs, then you do not deduct the employment allowance. It is not a deduction from one specific employee's employer NICs. It's a total deduction from all of the employer's Class 1 employer national insurance contribution payments. The employment allowance does not reduce the amount of employer Class 1A NIC that is payable. You can't then say, oh, well, I've only got employer Class 1 NICs of £2,000, therefore my £3,000 employment allowance takes out the £2,000, brings it to nil. Oh, and the extra £1,000, can I put that against the Class 1A employer's NIC? Answer, no, you can't. It only goes against the Class 1 employer NICs. So you can't put against Class 1A, nor can you use it to reduce the Class 1 employees' NICs either. Okay, so just to give a quick overview here, what you've got is a very simple basis of calculation. As we first introduced using our table as provided at the front of your notes here, as you get in the exam, you've got a lower limit for both employee and employer, below which you do not pay, 0%. For the employee, you have an upper limit of 50,000. Between lower and upper, there's your main rate, 12%. Above 50,000, it drops to 2%. For the employer, go above that lower limit of 8632. There is then no upper limit. It's 13.8%. If ever required to compute the total employer's NICs, then an employment allowance of £3,000 would be deductible. If we're asked for it, Class 1A, we are picking up on the taxable benefits provided by an employer to an employee, and that without any lower upper limits, it's just a standard 13.8%. Okay, time now, therefore, for you to have a go at a little exercise here. Example 1, we've got £60,000 per annum. Clearly, therefore, we go above both the lower limit and the upper limit. Up to the lower limit, nothing. Between lower and upper, 12%. Above the upper limit, 2% for employee NICs. What we've also got is some taxable benefits. They, of course, are what would then be subject to Class 1A NICs. But before you do any calculations, read the requirement. Make sure you only do what you are required to do. Again, examiners give you enough rope by which to hang yourself there. Don't take it. What you've got to do, of course, is to look at what do they want me to do, then go find the information in the question that you need that allows you to do that, and ignore any other superfluous information. Don't just say, oh, but they put that into the question, therefore I must use it in my answer. No, what you do, you are question-led, not information-led. What does the question ask you to do? That's what you focus on. You don't look at just all the information in the question and say, how do I use that? Where does that go? That's not the right way around. So what have we got here? Calculate the Class 1 and Class 1A NIC liabilities in respect of this employee. In respect of the employee. So they're not asking you to calculate just the employee, Class 1 employee NICs, but all of the Class 1 and 1A NICs in respect of this employee. I.e., you've got to do everything. Class 1 employee, Class 1 employer, Class 1A NICs. The Class 1A will be simple enough. There are the taxable benefits times 13.8%. In relation to the employee, Class 1, 60,000 per annum, so up to 8632, nothing between 8632 and 50,000, 12%. Above 50,000 and up to 60,000, the total there at 2%. For the employer Class 1 NICs, well, nothing up to 8632, and then everything above 8632 taken at 13.8%. Right, time for you to get your calculators out, therefore. Do those calculations. We'll then review them together when you finish this exercise. So pause at this point in time while you do example 1, and then come back and we'll go through the answer before then moving on to deal with the self-employed. Okay, let's see how you fared, therefore, in relation to example 1. As we said, in relation to Class 1A employer NICs, it's a standard rate of 13.8% on all of the taxable assessable benefits. There were 2 of them, add them together at 13.8. Hopefully, I've done the calculator work correctly there, and that will be your Class 1A employer. The main amount of NICs will, of course, be Class 1. Firstly, for the employee. Lower limit and upper limit this time. So what have we got? Lower limit 8632, below which we do not pay. So nothing on the first 8632. Above 8632 and up to £50,000, your main rate of 12% there. Over the £50,000 upper limit, we've gone up to 60 there, so a further 10,000, pardon me, at 2%. Again, subject to getting the calculators out and using it correctly. All being well, that comes to a grand total of 5164. But again, the method is what is important here. Do make sure that you understand the bases of each part of that calculation. Easier in terms of quicker to deal with for the employer, because although we have the self-same lower limit below which we do not pay, there is no upper limit. And therefore 60,000 minus that lower limit at 13.8% gives you your, well, there's £7,089 of employer's NIC. Employment allowance of 3,000 would be deductible, but that would be deductible from the total employers. Oops, don't cross that out. But from the total employer's Class 1 NIC liability, it's not something that is deducted in deriving an individual or for an individual employee, what the total employer's NIC would be for that one employee. It is the total for all employees from which we make the deduction. Now you can see here that we're talking about some very significant taxation charges. Over £5,000 from the employee, over £7,000 in relation to the employer, plus another nearly £1,500 from the employer in relation to the taxable benefits. So this is a very significant tax that we're talking in terms of. Again, we do not have to theorise about it. All you've got to be able to do is to calculate it, and that should not be a difficult exercise now for you. Going back to your notes, and having dealt with the employees and employers dealing with employment income, we now deal with the self-employed. Whereas with employees it was all about class 1, now we have 2 separate classes that the self-employed may suffer. Now don't worry, this does not mean at all that the self-employed pay more in the form of national insurance contributions. In fact, it's quite the opposite, that they pay less. But what are these amounts? Firstly, a Class 2 contribution, or at least for a while yet a Class 2 contribution. Self-employed earners pay a flat rate contribution, £3 per week. Again, starting from their 16th birthday, and again, as it's an individual cost until they reach pensionable age. When the tax-adjusted trading profit assessed for the tax year exceeds a small profits threshold of £6,365. Again here, we only pay this £3 per week, assuming that the profits exceed that particular threshold. Again, a very, very low number, as you can see. How do we account for it? It's payable under the self-assessment system and will be due on the 31st of January following the tax year. When you get to Chapter 15, the administration section, dealing with individual personal taxes, we will discover that the main due date in relation to tax charges on the individual, the main due date will be the 31st of January following the end of the tax year. So for the 1920 tax year that we're dealing with in terms of our examinations based on Finance Act of 2019, for the 1920 tax year, the following 31st of January will be the 31st of January 2021. And at that date, you have to make final settlements in relation to income tax, but also settle your Class 2 NIC. But that, as you can see, is not a huge amount. And again, as we said there, 31st of January 21, along with the Class 4 NIC. Now, this is your main figure. £3 a week is a tiny amount by comparison to the figures we were looking at with Class 1. Class 4 is your main calculation. But again, read the question carefully. Does the question for the self-employed person ask you to purely calculate Class 4? Don't think they will ask you ever to just calculate Class 2. But if they don't say Class 4, then they're likely to say for you to compute the total NICs payable by this self-employed person, and the total is both the Class 2 and the Class 4. So read the requirement carefully. Class 4 contributions. And what we're going to see is, although we're now talking about a tax-adjusted trading profit being made by the self-employed taxpayer, rather than employment income for the employed taxpayer, we've got the same limits as we saw with Class 1 employee NICs. Just to take you back to the fact sheet, you've got your Class 2, £3 a week. There's your small earnings exemption limit in terms of the tax-adjusted trading profits being made by this individual. And we've then got the same lower limit as we had before, this time looking at our tax-adjusted trading profits for the tax year of assessment, up to that lower limit, 0. Between the lower limit and the upper limit, again £50,000 as for employment. We've then got the main rate, this time 9%. So although, yes, we're paying both Class 2 and Class 4, your main rate, the vast majority of the amount that you pay between your lower and your upper limit, is at only 9% instead of 12%, so far as the self-employed are concerned. Go above £50,000 of tax-adjusted trading profit, and that reverts back to, as we had with employees, to the 2% rate, with no further upper limit on whatever the amount of tax-adjusted trading profit would be. Go back, therefore, to the note. Self-employed pay Class 4 contributions based on the assessable trading profits of the tax year of assessment. We deal with the 1920 tax year. Up to 8632, it's nil, and then 9% payable on the trading income assessment between 8632 and 50,000. Above 50,000, 2% is payable. Again, like with employees, start at age 16. At the start of the relevant tax year, contributions begin. Again, it's not very likely that many 16-year-olds are going to be self-employed, but contributions begin if the employee is 16 at the start of the relevant tax year, but contributions cease when the taxpayer reaches pensionable age, again at the start of the relevant tax year. And here we've got example 2 for you to enjoy, and this time a trading profit assessment of £60,000 for the 1920 tax year. What have we got to do? Class 4 and Class 2. Obviously 60,000 is above that small earnings limit that we referred to in relation to Class 2, so it's £3 a week for 52 weeks. Class 4 is your main one, and what have you got? A trading profit of 60,000. Up to 8632, nothing. If you take from 8632 up to 50,000, so 50,000 minus 8632 at 9%. And from 50 up to 60, so 60 minus 50, another 10,000 at 2%. And that will be your Class 4 NIC. Put the two figures together, and that's your total of both Class 4 and Class 2. Shouldn't need me to review through, therefore, the answer to that. You do your calculations and check that out with the back. And that will then mean that in relation to income, we've now dealt both with the income tax system, other than the admin part of how and when do we pay the income tax due for a tax year. But we've established for each amount of income how it is to be charged to tax in relation to a tax year, and in relation to the two main types of income, employment income and trading profits of the self-employed, how we also deal with national insurance contributions. So we've got two taxes tied to levels of income. We now move away from income-based taxes to look at capital taxes. To begin with, we're going to be looking at capital gains tax, CGT for the individual. CGT, in terms of your chapters, is split into two separate categories. We'll deal firstly with how CGT impacts upon an individual, and that's the forthcoming chapters. After we've dealt with the individual, and we've dealt with income tax, NIC and CGT, we then turn our attention to corporate tax, the second biggest area in terms of your syllabus. And having dealt with the preparation of the corporate tax computation, we will see that a company is chargeable to corporate tax on both their taxable income for a given accounting period and also their chargeable gains. Whereas you or I as an individual will have separate liabilities for income tax and capital gains tax, a company pays a total corporate tax figure based on its taxable total profits, which is a combination of both income and gains. So we'll look at the particular issues relevant for corporate gains in a later part after we've studied the corporate tax. But coming up next, the next main personal tax, CGT. I look forward to dealing with it with you.